Depending on your perspective, this is our economic and financial outlook for 2022. Crash, boom, or something else?
Via the economist and the advisor. And I totally did not know that this topic was up today, so I'm not going to have I would have some witty things to say, but I couldn't pull them up. So I'll just be more practical today. So go ahead, take the lead today. You got the lead.
You can tell me.
You're the economist. You do give us the forecast for 2022.
All right, okay. We know how much you love forecasts.
Right, yes.
You always seem like
get your crystal ball out.
Get my crystal ball out, right? So 2022 predictions. Look at this. Like, is it going to be a crash? Like Robert Kiyosaki says, depression and crash is on the way. Harry Dent, he's a kind of a contrarian investor.
Oh, yeah. Harry's been around a long time.
Been around a long time. What does he say?
Sky is falling. He's been saying it for 20 years.
I know. In 1 year, he'll be right.
He will.
He'll be right.
He'll eventually make up, right?
Yeah, and then over here, what is it? Stansberry Investors chief economist Matt McCall says, hey, the S&P's going to be up 20% next year. So this is gambling or what here? So my favorite is Yogi Berra, and your favorite's probably Larry Swidrow on this, right?
I like Larry's. His crystal ball is always cloudy.
Crystal ball is always cloudy, and with the Yogi Berra, forecasting is very difficult, especially when it involves what? The future.
Exactly.
So, anyways, I can't tell the future. Mike can't tell the future, but we can give you some insight, perhaps, on what we could see possibly given past trends with different indicators. And I know this slide here I have 7 economic indicators, and what we call leading economic indicators, right, Mike? And I want to show you what they're suggesting. Doesn't mean this is going to happen, right? But they're suggesting this. So you can see here on the left-hand side, I've got different variables like the yield curve, the money supply growth, the number of housing starts, how are consumers feeling about the economy. And then there's a threshold level. And that column, it needs to be above that to be positive. So for example, the yield curve, which is looking at long-run risks versus short-run risks, the long-run risk, you can think about it as like being like 75 basis points higher than the short-run risk, and that's the threshold. But if you go back into 2007, right before the Great Recession, which is kind of like, that's the big recession.
The reset,
the reset. You can see that it was actually negative, so that's why it's in red. Today it's at 137 basis points, which is saying like, hey, this makes sense, and it's positive. So anything in green is good, and anything in red is suggesting bad or negative. And you can see over at the latest, this would be like mid-December 2021, that, whether it comes to yield curve, money growth, housing stocks, monthly change in jobs and oil, the only one that's negative there is consumer sentiment. And, consumers are a little bit shaken up, Mike, for various reasons, COVID related and, all different reasons. They have a negative outlook.
Well, the media prefers that negative.
Oh my gosh,
I seem to think,
Absolutely. That's true with the financial media too.
Bad news sells, I guess.
Bad news sells, right. So anyways, 6 to 7 are saying positive. We should not technically have a recession in 2022, at least for the next 6 months. We should not have a recession. So viewers, get that through your thought. And I did I did actually some Probit modeling yesterday.
Probit modeling, nice.
Yeah,
with a goose.
With a goose. So what I did is I stuck in the spread here of positive 1.73 of the yield curve and put in some values for some of the coefficients, and I came up with about 12.7% chance of a recession. What do you think about that?
Well, I'm going to add my forecast at the end when you're done. So
okay.
I'm going to surprise you here. I'm going to come up with a forecast.
Yeah, I don't know if Mike has a book he gave me when the first time he met me. It was called The Black Swan. Remember that book?
Right. Yeah.
And I don't know if you know this, but what fraction of geese are black feathered?
2%.
It's very small like that.
Is it?
And it's mainly they're out in New Zealand and Australia. That's the only places on Earth you'll find a black swan, unless they've been brought over. And even there, they're very rare as well. So a black swan event, we need to stay vigilant this year, folks. There's, as we talked about when Amit was here, like there's a lot of fear, uncertainty, and doubt. A lot of the markets are kind of in pain right now, slightly, kind of a little bit of correction. There's a lot of downside risks, and there's a bunch of them, right? What are some downside risks you see easily?
Well, there's so many. You have geopolitical. We could have Russia invade Ukraine. We could have China invade Taiwan, or we could have COVID take off with its third
Yep.
variant and shut down again. I mean, there's so many moving parts that can impact the economy beyond the economic numbers that you mentioned here.
Yeah, it's the unknown
Which makes it
unknowns
so
we don't
difficult.
know, right?
Right,
Like what happens if Jay
exactly.
Powell screws up and increases interest rates too quickly? So I've got a few slides here, and this presentation won't take too long. So just hang with me, folks. These are some of our projections on interest rates, inflation, and the stock market. So this is Jay Powell. He just gave a FOMC.
Oh, wait a minute. This is the professor's forecast.
Yeah,
I
know.
have my own here at the end.
Oh, yeah, okay.
Yes.
And what Jay Powell's saying is he's saying like, hey, we're going to speed up the tapering. He knows he's behind the 8 ball. He's in a tough spot. He needs to get interest rates moving as inflation's kind of picking up. So the good news and bad news. Here's the great news, folks. Interest rates will not increase until at least May of 2022. And that's what he said on his latest FOMC meeting. So that's good news for us. The question is, what happens after that? And what we're looking for is about 75 basis points or less than 1% of interest rates in the short run. And that's potentially a big deal. So what I have on this slide here is the Federal Reserve Open Market Committee's what they call dot plot. And each one of these dots are individual, what they predict what the Federal Reserve should do to interest rates in 2021, 2022, and 2023. And you can see there that in 2022, that the majority of the FOMC members say, hey, listen, we should be at 75 basis points. And then we'll increase rates 3 more times in 2023 to 1.5% roughly. And Mike, I don't know if they can get that up to 1.5. I think there's just so much uncertainties, a lot of debt overhang. The Fed's kind of boxed in a corner. I don't know if they can raise rates to 1.5% in 2023. It's a different time. So anyways, that's their forecast. They think in the longer term, they're going to get back up to 2.5, folks. I'm not sure if they're going to get there, frankly. So that's our interest rate outlook is next year. The markets might have a little correction, perhaps. You know, who knows?
Thank you.
Who knows? When interest rates start to rise, if you see maybe the second or third interest rates hike, that might be a time where you might see a little bit of a correction. We'll see. Inflation for next year.
I would call it an opportunity to rebalance or dollar cost average.
Here it is.
Thank you. Yes.
Not
to do anything else.
Yeah, inflation. I think for everyone's worried about inflation. It's the number one topic right now. As you guys go to your Christmas meals and holiday meals, you're going to talk about inflation around the table. It is going to persist well above the Fed's 2% target. Sorry to say that. And there's a lot of reasons for it. And one of the reasons for it is just what people are seeing on the ground. I mentioned here that methodology has changed, that inflation is really not 6.8%, but probably closer to that 12% roughly. Look at the difference in the rent rates that the FOMC uses versus the housing prices. Housing prices shot up 20% this year, folks. That's housing inflation, and yet the owner's equivalent rent is only at 8.4. So that's bleeding into the inflation outlook for the society. And also another thing is in November, we just got this last week that the producer price index is at 9.6%, folks. That's the highest it's ever been. And that's going to be bleeding into our system next year. So we've got a big job.
Bleeding in. That's not a good term.
It's not a good term.
To scare people.
Well,
Bleeding in.
I've got some good things to share with you folks as well.
This
is not the good one. Okay.
This isn't very optimistic.
This is on debt here. Okay.
Yeah,
So this is not, the debt is going to increase next year. The national debt is unsustainable. This week, the Congress approved the debt ceiling increase by $2.5 trillion. And I just want to set this up for you guys. Think about this. When we had inflation back in 1970s and early 80s, we had the Volcker, the Volcker plan. Paul Volcker came and Ronald Reagan was president, and they said, we're going to get serious with inflation. Mm-hmm. How much did they raise interest rates to?
Oh, high.
Yeah.
What was it,
20% roughly in 1980, 81, it got up to 18, 19, 20%. My mom and dad, think about this, folks. They bought their first home in their dental practice at 20% interest rates. Oh. And it was just killing them, that interest. So back in 1981, at the end of the year, I went and looked yesterday, the national debt was $1 trillion, Mike. What is it now? $29 trillion. What will it be? $31 trillion. The Fed is boxed in. They can't raise rates
Trillion here, a trillion here. Pretty soon you're talking about a lot of money, Joshua.
Yeah, it can't.
Yeah,
and so, anyways,
exactly.
one of the recommended books I have for the new year for all of our listeners is Ray Dalio's The Changing World Order. And he talks about the United States kind of being at stage 4 when there are great excesses in spending and debt and widening of the wealth gap and political, gaps.
Sure.
Think about that. It's so interesting. So something to look at, folks. So we'll put that. I'll have Ryan put that up on the link on below. This is So the next one is assets. So what should we project for assets? And again, the crystal ball is unclear. This is Vanguard's 10-year annualized projected returns. You can see here that they are reverting to the mean. Really, the value, small caps, emerging markets do okay. But they're down. Their 10-year projections are down.
I noticed they left off international there, but that.
Yeah, I was.
Oh, you left. Yeah, that would be okay. That would be another one that's probably a little more positive than U.S. Okay, sorry.
Yeah. So I think Mike, you might have been pushing some of your clients to go a little more international, a little more emerging.
No, we're not going more. I mean, we're sticking with what we got, but we try to 30 to 40% of the equity allocation we recommend being international.
Yep, that's what we have it.
Diversification.
Okay, so the last thing we want to talk about is lighthearted predictions, and I have 3 of them for all of our viewers.
Okay.
The first one is, after years of Mike saying that he's going to have an open house, we want you to come to Cypress Asset Management next year. We're going to have an open house.
Perfect. All right.
Right here in Peoria Heights, Illinois.
Our 15th anniversary here in Peoria. So.
All right. So can we get that one?
And our 20th anniversary of being open. So yes, we're going to do that. That's a goal. Okay.
Second lighthearted prediction is that just for fun.
Perfect.
Bradley University wins the Missouri Valley basketball tournament, and we go with the March Madness. And the last one is. I need your help on this.
500. There we go. We're going to get 500 subscribers.
500 subscribers, folks.
So I can't shoot for $1 million?
Not yet.
We got to get to 500. I'm with you.
That's right.
Okay.
All right, Mike. So what we have to say here.
Can I take my forecast?
Go ahead.
Since this is totally off the cuff. So I do think what you mentioned there, one, is I think at some point we are going to forget about valuations on the market with growth versus value and size and small and international, et cetera. We're going to get reversion to the mean in numerous asset classes at some time, because for the last 5 years, large growth has been on a tear, let's face it. But I have no forecast when that's going to occur. Is that going to change what my philosophy of people's portfolios? No, we're going to stay diversified. We're not going to make any tactical changes. As far as interest rates, I think that's like forecasting the market. We'll wait and see what all that does. But as Larry Swedrow says, my crystal ball is always cloudy, so I don't make forecasts.
I understand that.
It's fun.
Yeah, it's
I
fun.
guess. But as we talked about with the randomness, we'll see. There's a lot of moving parts in the global economic capital world that we live in today. So.
Absolutely. Remember Amit was saying that nebula, that cloud of hundreds of thousands of possibilities?
Yes.
We don't know.
Focus on what we can control.
Focus on what we can control. And that is diversification, keeping your fees low, and have tax efficiency.
So next week we can do the holiday season. I can bring my Christmas hats, and maybe I get my grandson to be the first one to come on for the clip for future videos.
As long as Santa's not here. As long as Santa Claus,
he might come in. He'll come in for 30 seconds maybe. We'll see if we can get him to sit down.
Well, folks, thanks for watching the
watching.
forecast
Bye.
of 2022. We're out.